Everyone's heard it. Business loans are impossible to get unless you're already big, rich, or have perfect credit. That's the myth. But here's the hidden truth. Top performing companies are quietly flipping the script and getting approved faster and more often by playing an entirely different game. Stick around to see how they're doing it and why the old rules just don't apply anymore. Let's get straight into the playbook. First up, secret number one, the smartest founders are hacking approval odds by applying for business lines of credit, not traditional term loans. Why? In 2025, major lenders are approving business lines of credit at a rate of 73%. Compare that to just 38% for standard business loans, almost double the chance of a yes. Take the case of a regional e-commerce company that pivoted to a line of credit as their primary funding tool. Not only did they get approved in under 6 hours, but their conversion rates on high-volume sales jumped 34% once they could offer instant buyer financing. The lesson? Winners play the odds, not the legacy process. Secret number two, high-growth companies are leveraging digital footprints and real-time data analytics to get lenders to say yes faster. Here's the unconventional move. Instead of relying on old-school collateral, they built a rich digital profile, integrating payment histories, supply chain metrics, even equipment utilization data directly into their application. In 2025, 78% of e-commerce lenders now offer instant credit decisions for purchases under $10,000 by analyzing these digital signals. A mid-sized SaaS firm in the Midwest used this approach, plugging in their cloud usage data and automated invoices. Result? Approval time dropped from 3 days to just 5.3 hours, and they unlocked a new revenue stream by offering credit to their own B2B buyers. The old paperwork grind is being replaced by a data-rich, show, don't tell approach that lenders can't resist. Secret number three, the most resourceful businesses are exploiting lender segmentation, applying strategically to maximize approval odds and minimize wasted time. Here's what top performers know. Approval rates at small banks, credit unions, and specialized finance companies now hover around 51 to 52% compared to just 31% at online lenders and 44% at big banks. A family-run manufacturer in Ohio mapped out their application sequence, starting with a credit union, then a small bank, only approaching online lenders as a last resort. By targeting high approval channels first, they secured $120,000 in funding after just 2 weeks, money that would have been left on the table if they'd stuck with the big brand names. The secret? It's not about spraying and praying. It's about precision targeting, just like a winning marketing campaign. So what's really happening here? Picture this. Most business owners are stuck at the gates of a fortress, banging on the front door, waiting in line, and hoping the guard lets them in. But the companies who win? They've found the side entrance. They know the guard's schedule. They understand which doors open fastest and which ones are dead ends. They're not just asking for money. They're showing why lending to them is a no-brainer with proof in hand. The loan process isn't about begging for approval anymore. It's about presenting a compelling, data-driven case that lenders can't ignore. Imagine your business as a high-speed train. The old model says you need to build the whole track, prove you've never derailed, and then maybe, just maybe, someone will let you board. But the new model? You lay down smart track segments. One line of credit here, one digital profile there, a targeted lender approach, and suddenly you're not waiting for permission. You're accelerating destination in sight while others watch from the platform. That's the mindset shift. Don't ask for a ticket. Build your own express lane. Now for the stats that should light a fire under every founder's seat, digitization and targeted applications are slashing approval times by over 40% across manufacturing and B2B sectors alone. In fact, medium-sized companies using these tactics now see approval rates up to 77%, nearly double the industry average for conventional loans. But here's the jaw dropper. Retail and e-commerce businesses leveraging next-gen credit models are reporting a 34% increase in completed transactions simply by offering sub-hour credit approvals. That's not incremental, it's transformative. The companies owning this playbook aren't just getting funded, they're growing faster, outpacing competitors, and locking in customer loyalty that money can't buy. Here's the bottom line. Business loans aren't hard to get for the companies playing by new rules. The real challenge? Breaking away from the old, slow, paperwork-heavy ways and adopting the secrets that high performers already use. Stop thinking of loan approval as a black box. Start thinking of it as a high-speed, data-driven negotiation, one where you control more levers than you thought possible. So if you want your business to win, ditch the myths. Go where the approval rates are highest. Turn your digital trail into undeniable proof and target lenders who are primed to say yes. Because in 2025, the gatekeepers are changing and the side doors are wide open for those willing to walk through. Are you ready to move from waiting to winning? The clock is ticking. Make your next move count.